Morning, everyone. Right. Here we go. So my name is Matt Crosse from Blaser Mills. Blaser Mills is a law firm, principal offices in High Wycombe and Silverstone, and we specialise very much in advising SMEs and owner-managed businesses. A little bit about me. Principally, I spend the vast majority of my time with the corporate law aspects, so that mainly involves buying and selling companies, financing of companies, debt, equity, including private equity and investments, and also some reorganisations as well. Again, that's all focused at OMBs and the SME sector. So getting on to the scheme itself. The scheme was launched on the 23rd of March, and I think it's fair to say there was some initial criticism, as a result of which at the back end of last week, effective this week, there was some fairly fundamental changes made. So I'll point those out as we go along. Just to give a general overview, the actual scheme is run by the British Business Bank in terms of being the operator or overseer, but it's not the British Business Bank that actually makes the funds or advances the funds. That is, as you would do with any normal bank facility, that is still coming from your high street bank, your challenger bank, whoever your bankers are. But as I say, British Business Bank oversees it. For those of you that don't know about the British Business Bank, it was set up in November 2014. It's wholly owned by the government. It's independently managed, and its main aim is to increase the finance that is available to small businesses. Now, the British Business Bank has accredited over 40 lenders to be able to offer this scheme. A list of those accredited lenders, which is growing all the time, is on the British Business Bank website, and I do advise you to go and have a look at that website because it is very useful indeed. As I say, the accredited lenders are the normal, pretty much most of the high street banks and some of the challenger banks as well. I think it's important to say that because there is debt and asset finance available under this scheme, you may find that not all lenders provide all of it. So, for example, the asset finance companies will be sticking to what they know and providing the asset finance and not debt as well. The government covers 80% of the lender's exposure under this scheme. But I think it's important to say that the government still expects, just like any normal bank loan, that if there is a default, then the banks will pursue the customer as they would normally and exhaust every avenue to get back the full amount of the money that's left outstanding before the government will cover the 80% of the debt. And as I said at the last bullet point, that is tied to the fact that the customer is still 100% liable for the debt. So nothing's changed in that respect. It is the same as any other normal bank loan or facility. Clearly, what's very attractive under the scheme, which is penultimate bullet point, is that the government pays the first year's interest and any lender arrangement fee. And certainly a number of the banks are also, in addition, offering some capital repayment holidays, 3-6 months, that sort of thing. Don't know if that was me or a gremlin, but never mind. The scheme is going to be available for at least 6 months, and the government has said that it's demand-led. So if there's still demand, it will be extended. And also that also applies to the amount of money that's going to be available. Yep.
Matt, sorry to interrupt. I'm not sure if you've still got control of the slides. Could you just take the control, because we're on a different slide at the minute. That's it.
Yep.
Brilliant stuff. Thank
That's
you.
all right. Okay.
Uh,
So yes, so available for 6 months, and it's going to be, as I say, demand led. So in theory, there's no limit to the amount of funds that could be advanced under the scheme in total. Looking at the criteria to be eligible for the scheme. So you've got to be a UK trading entity. Maximum turnovers 45 million. That's based on the 2019 figures. You can, if you've got a group of companies, apply for individual companies within that group to take facilities under the scheme, provided the consolidated group turnover doesn't exceed 45 million. The term of the facilities is up to 6 years, but they do divide it with different timescales. So for term loans and asset finance, it can be anywhere between 3 months and 6 years. And for overdrafts and invoice finance, it can be up to 3 years. The company's business income must, at least 50% of it, come from trading. So if there's a heavy investment activity in the business, that may well disqualify it. There's probably not, for many businesses at this level, going to be an issue over whether there's been any state aid in the last 3 years, because that potentially can disqualify you. But there has been a recent slight change in that, in terms of any de minimis funding that has been received won't count towards assessing whether you fulfill the criteria or not. You've got to be in an eligible industry, and to be fair, that's very, very wide. The exclusions are very narrow. It effectively excludes any business that does banking, insurance, and some further educational organisations. So it is pretty narrow, really, the exclusions there. So in order to apply for the scheme, you need to self-certify that the finance is required because of COVID-19. One of the important changes that came into force this week is the next bullet point, where the requirement for insufficient collateral was removed. So initially, the banks had to look at the lending proposal in the business, and if that met their normal lending criteria, they had to go down the normal bank products that were on offer, and were not eligible for the scheme. So one of the changes was, even if there is sufficient security available, you can still qualify and be part of the scheme. You can borrow up to 5 million, but the borrowing can't exceed 25% of turnover or 2 times the annual wage bill, again based on 2019 figures. The business still has to be viable, and there still needs to be to be able to demonstrate the ability to make repayments. So the fundamental underlying business still needs to be sound in order for the banks to admit you under the scheme. Now, the next slide, I think there's been quite a lot of press about this, and again, some of the recent changes that came into effect this week deal with this. So if the facility is less than 250,000, then the banks can't ask for personal guarantees. When the scheme first came out, the Big Four voluntarily agreed not to ask for them, but now it's mandatory that if you're below the 250k limit, none of the accredited lenders can ask for personal guarantees. If you're borrowing more than 250,000, then personal guarantees are at the lender's discretion, but they're going to be capped at 20% of the debt that's left once the assets of the business has been realised. So clearly quite a significant shift there in terms of personal guarantees and directors' liabilities. The next bullet point, as I said, was one of the other changes that were made as well. So even if there is sufficient security, you can still apply to become part of the scheme. The flip side of that, of course, is that clearly if there is security there, then the banks will be looking to take that, certainly in the form of a company debenture if they don't have one already. If you do have to give a personal guarantee because you're over the £250,000 limit, the person giving the guarantee, their main residence will be excluded from that, but clearly their other personal assets will fall within the guarantee. And I think it's important to say that the changes I mentioned apply retrospectively. So if you were applying for a loan or took out a loan before the changes came in this week, then the bank should be going back and retrospectively applying the new criteria. So in the case of where you were refused, they've got to look at your application again. And I would say also that probably applies to personal guarantees. So if your facility in the first couple of weeks you took one out was under 250,000 and you had to give a personal guarantee, I would say, looking at the wording, that personal guarantee should be removed.
Matt, just to
Yeah.
interrupt you there, sorry, you're in a flow. I have a message from Ewan. What does trading mean? Could it include income from donors, trusts and foundations?
That is a good point. I mean, trading is most of the time where that definition is used is in a accountancy context in terms of looking at whether entities qualify for various tax reliefs and do they receive income as part of a trade rather than, say, from an investment activity. So off the top of my head, I'm afraid I'm not entirely sure. I mean, it's interesting that in terms of the excluded sectors, there's nothing in there that mentions things that would tend to indicate, say, not-for-profit organisations who I assume would have income of that sort of nature. So my gut feel would be yes, that would qualify, because if the intention was not to sort of help that sector, then they'd have probably been in the very narrow definition of excluded sectors. Okay, in terms of the making the actual application itself, I think it's fair to say that pretty much all banks at the moment are dealing with their existing customers. So any new to bank customer is being put right at the back of the queue. So you do need to approach your existing bank first in terms of looking to apply for the scheme. In terms of the documentation required, it's pretty much similar to the situation where you would be applying for one of the bank's normal products anyway. So it's a combination of financial information, really. So it's last 3 years accounts, statement of assets and liabilities of directors and shareholders, business plan, cash flow forecast. And to be honest, I appreciate it's really difficult for people to put some sort of cash flow forecast together. But going back to the earlier slide, I think that is going to be quite a key document in terms of the application, because as I say, one of the criteria for the banks is to have a credible ability for the business to make the repayments. So the cash flow forecast at the best of times is always slightly finger in the air. At this point in time, it's even more so, but it will be something that needs to go with the application. Details of any other government assistance, principally that for most businesses, I expect would include the EFG loans that were introduced back in sort of 2008, 2009. But apart from that, I suspect there won't be anything else for pretty much most SMEs to declare. Management accounts clearly as up to date as possible and as is reasonable, and a list of creditors and debtors as well. In terms of what I've seen or heard speaking to people, the sort of interest rates on the products, yes, I think we've all seen stuff in the media about sort of 15, 20, 25, 30%. The people that I've been speaking to are saying the products, the interest rate is about 3 to 5%, depending on where you go. So that's some of the sort of practicalities that I'm able to feed back. But I'm happy to take any other questions that people may have.
So any questions anyone's got, if you could do that in the chat room, and then I can read them out to Matt and we can get some answers for those. Okay, we have a question come through, Matt. So should the company that applied for CBILS last week reapply again?
I think it's definitely, yes, worth doing so if, as I say, the reason for, I'm assuming this is where an application's been made but refused. If it's not refused, then the application should still be being processed, but with regard to the new criteria in force as of this week. So in terms of no personal guarantees and not being disqualified for having sufficient security. So that should happen automatically by the bank. If the application was refused, then depending on the reason why it was refused, or the customer, the business didn't want to go ahead, then yes, I think definitely that they should reapply. So for example, if the reason maybe was the business didn't want to go ahead because the bank were asking for personal guarantees and it was under, the loan was under 250,000, then certainly you should be making that application again. And equally, I think if it was refused because the bank was saying, look, we can lend to you under our normal product criteria, so we're not going to push you into the scheme, then again, I would definitely contact the bank again and ask them to reconsider.
Okay, great, thanks, Matt. Another question we've had through is, do you have a pro forma business plan that the banks like to see?
I don't personally. That tends to be done from the accountant's point of view. So the company accountant's point of view will tend to work with the company in terms of putting the business plan together. I suspect there will probably, like most things these days, be something online that would be a good starting point. But no, I'm afraid I don't. As I say, that's not something that I would typically get involved in.
Okay, thanks, Matt. Next question is, how long is it generally taking for applications to be reviewed, agreed, or agreed?
Very good question. And the the relationship managers I talk to at some of the banks, and I'm not criticising them, haven't given me a figure. It's very much there on a customer by customer basis. So I think it would depend on how well the bank knows your business, how often you interact with them in terms of supplying them up-to-date information, and how their view of your business, how up-to-date it is. I mean, if it's any use, I think, as I say, the scheme went live on the 23rd. At the back end of last week, there'd been about 1,000 facilities granted under the scheme across the country. So that's in the space of what, a couple of weeks, and I suspect there it's a case of those businesses, those customers, having a relationship with their bank where the bank has been kept up to speed on a fairly regular basis in terms of the business and how it's doing and what the prospects are. So I'm hoping that's some sort of use, but yeah, I haven't got any actual time period that I've been told about by any of the banks.
Okay. There's a few more that we've got come through. Matt and I will stay on, longer on the call if we have more questions. There's another one that I'll read out. Do you have any view as to whether the specific new or different scheme may be forthcoming for the not for profit sector?
Possibly. I mean, I know it's not quite the same sort of thing, but if you look or compare it with, say, what the government did for the job retention scheme and employees, and then when that was announced, there was talk about, okay, well that's great, but you've excluded quite a big sector of the working population who are self-employed. So they then brought in some help for the self-employed. I think possibly there may be, yes, a similar sort of approach in terms of, well, we've helped businesses in the sense of trading businesses, SMEs, but that not-for-profit sector has not necessarily been supported. So I think it is possible, especially when you look at some of the running costs of those organisations and the fact that a lot of their income that they need is raised through donations, fundraising, etc. And from a cash flow point of view, of course, a lot of that has been pushed back, or is either not going on or has been pushed back to later in the year if it's a fundraising event connected with the London Marathon or something like that. So I would hope that they are looking at it, as I say, purely from a cash flow point of view. So I would hope there might be something coming.
Okay, thanks, Matt. The press has a lot of stories about only a small percentage of applications being paid out. Matt, have you seen this in practice? What have you seen in practice?
I mean, I think it'll be quite interesting to see at the back end of next week where we are in terms of the number of applications that have actually been granted. As I say, I think people were probably hoping, to be honest, that there would have been more made by the end of last week, and I think there was some, well, I know there was some criticism that of the first 1,000 odd applications that were accepted in the first couple of weeks, two of the sort of pretty much well-known high street banks weren't in that list of lenders that had made those 1,000 loans at all. So I'm hoping that there will be a sort of industry shift, especially now the criteria has been relaxed. And I think I can certainly understand people's frustration, but I think initially, again, when the criteria came out, some of the loans were being refused simply because the banks were looking at the criteria that had been laid down, and applying it correctly, and it was the criteria that was wrong rather than the banks doing or not doing something they shouldn't do. So I'm hoping now that certainly the change that says if you meet our normal lending criteria, previously we couldn't give you a loan under the scheme. Now that's gone. Really, there should be, the only reason not to get a loan, if you forget about all the other basic qualifying criteria, the only reason should be that is that the business plan is not credible. Most SMEs should be able to meet all the other criteria. I appreciate if you're looking at more than 250,000, then the personal guarantee point is obviously a big consideration before you go ahead. But again, I think that the change that came in this week to reduce exposure under the personal guarantees should help directors, shareholders to be able to make that decision if they are asked to give one.
Okay. Thanks, Matt. The next question I have is, could you clarify the amount of loan that will be allowed in terms of turnover or annual wage bill? So given an example of if a turnover for £1 million, maximum loan 250,000.
Yeah. So that's right. Sorry, could you read back that question, Maxine?
Yes, could you clarify the amount of loan that will be allowed in terms of turnover and annual wage bill? So the given example I have here is if a turnover of £1 million, for £1 million, would the maximum loan be 250,000?
Yes, it would. Yeah.
Okay, brilliant. Does that answer your question, Maria, who posted that? I think it will. She'll come back. Next question, Matt, is what do I have here? Someone missed the bit on interest rates. Would you mind just repeating that, please?
I'm not sure if that was. There were two probably things I mentioned on interest. One, from what I've gathered personally, the banks that I have spoken to are saying that the rates on the products are between 3 to 5%. The other point was that the interest for the first 12 months will be paid by the government, and any arrangement fees that the lenders make as well. So I think those were the 2 points where I mentioned interest.
Okay. I think I've covered all the questions that have come through. Is there any questions I've missed? Anyone that's still on the webinar? I think I've got another one here actually, Matt, just come through. Could you clarify to minimize state aid and relation to the CBILS? A company can get up to €200,000,
€200,000, yeah,
over 3 rolling years. Does it mean a company that's got, say, for example, €50,000 can apply for for the loan?
Yes. Yeah.
Okay. Is the loan available 25% of turnover or 2 times annual wage bill?
The wording that I'm just looking at the legislation here, bear with me. So I'm just checking whether it's an either or thing. Yeah, looking at what I've got here, it's either not to exceed 25% turnover or 2 times the annual wage bill. So I think it may be a sort of double test. So it can't go either over either of them.
Okay.
So that's how I would interpret that.
Okay, Matt. Just a few more questions coming through still. So, is it worth arranging a facility even if you might not need it?
Yes, I mean, in case of need funding, I think so, simply because I think none of us know how long the current situation will last, and then again, none of us know when it's over how long it's going to take for things to get back to normal. So certainly, if there is a point in the reasonably near future where cash flow is really going to suffer, then I think it would certainly be prudent to have the facility available should that period of time go that far, and yeah, the business need an injection of cash.
Okay. Great, thanks. Is it wise to overestimate on the amount of the loan with the view that we can pay back if not needed, on the basis of we do not know how long this will go on for?
Yeah, no, fair point. Sort of connected with the previous one. Yes, I think the only thing to bear in mind in terms of looking at the amount is just the serviceability in the business plan or cash flow forecast. But yeah, other than that, I think that's a prudent approach to take, definitely.
Okay. So we've got another question here, Matt. So re-interest rates on loans, like with the EFG scheme, this operates in two-tier market. The high street banks charge 3 to 5%, but if you go to any of the other 30 or so lenders on the panel, you could end up paying far more. For example, Ask IF charge 6% arrangement fee, and interest rate of 16 to 17%. And then we've gone on to say maximum loan, a maximum of 25% of 2019 turnover or double the annual wage bill, whichever is greater. Does that make sense, Matt? Do you want me to go over that again?
Yeah, no, sort of. I think there's probably 2 points I'd make there. I think it's unfortunate that there's not the practical ability for people to shop around at the moment. as I said, for a number of reasons. One, because a lot of banks aren't accepting new customers at the moment, and I think the second practical point would be, even if they were, it's going to be difficult to process a new to bank customer, given the inability to do a lot of day-to-day stuff, certainly in terms of the bank doing due diligence on your business, and if that involves looking at available security in terms of premises, etc., then being able to get a survey done, etc., is going to be very difficult. So I think one of the practical failings of the scheme is the fact that people are driven or stuck with their existing lenders to a certain extent at the moment. In terms of the challenger banks or the other specialist finance providers, I haven't actually heard too much about what they're looking to charge, but it's interesting from that question that there is a bit of variance. I think the statistic I saw, was that 85%, I think, of SME businesses are looked after by the big four banks. Whether that's true or not, I don't know, but I'd certainly think they've got a significant share of the market. So yeah, that's my view on that.
Okay. I hope that sort of answers your question, Sean. We've had another question for you, Matt. We've had a significant equity investment over the past year to scale our business, and revenues have been growing at a rate of 100% a month or month on month. Equity investment has exceeded revenues by more than 50%. Okay. Super significant. Wayne, can you let us know a bit more about your question there, please?
Okay, can you hear me?
Yep.
So my question is that over the past year, we've had significant equity invested in our business to scale our premises and also to employ further staff and so forth. We've spent a lot of money on that, and we've only recently, over the past 4 months, started to scale our business aggressively. Our income for this period is less than 50% of the equity that we've received through private placement in our business. Do we still qualify?
Yes, yeah. I can't see that being an issue.
Okay, is that okay, Wayne?
Yeah, I thought there was a slide that stated that your actual trading revenues need to be 50% of your revenues in one of the earlier slides.
Yeah, that's right. But I'm assuming from what you said, Wayne, that your income is from carrying out what most people would regard as a trade, albeit that the amount may have changed.
Yes, enough. In this year's accounts, the equity will far exceed what our revenues are. That was my only question here.
Yeah, no, I think
I've effectively shut my business. I've had to shut my business down. I'm a food producer.
Right. Okay. No, I mean, I think you should be fine. I think that's really getting at where businesses don't carry on what most people would regard as a trade. So they don't employ people, they don't have premises, and they sort of invest in stuff and buy low, sell high sort of thing. I think it's that's why that criteria is in there. But in terms of what you've said about being a food business, I can't believe they intended that to disqualify you.
Okay, thank you.
Thanks, Mo. One more question I have here, Matt, and it's what is a in case of need funding application compared to a loan application based on a robust business development plan?
I mean, I think the in case of need funding would be, look, we haven't got any specific plans to do anything with this money. It's just there in case cash flow doesn't pick up and this current circumstance continues. I think the other scenario of where you're applying for a loan is normally for a specific purpose, to either expand the business in terms of premises, or taking on more staff, or buying more capital equipment. So you have a specific purpose and plan as to how those funds are going to be utilised, and you will be using those funds if you do get the loan. Whereas, as I say, I think the in case of need funding is it's just there, and we may or may not use it if we get it.
Okay, that's great. Well, I think we've got another question come through. With regards to the interest rate, we are saying that the bank charge the interest, but on the BBB website, it is written the government will make a business interruption payment to cover the first 12 months of interest payment and any lender leaved charges. Can you share your opinion?
Yes, you're right, and I'm not entirely sure why it's treated or called under a separate name, but effectively, as part of the application, you will authorise that the government pays that first year's interest to the lender direct. So that's my understanding of how that will work. As I say, they do term it as for whatever reason, a standalone, if you like, defined term within the scheme criteria. But for me, that's part and parcel of the same thing, albeit for reasons I don't know. That, as I say, it's treated as a separate payment and not part of the overall scheme. But as I say, my understanding is that is dealt with in the application process, and it's sorted out between the government and the banks.